Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to GetRetiredStayRetired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday. The roller coaster exists. You want to talk about drops followed by pops? Oh my heavens, that's exactly what we've seen. The stock market, the Dow Jones, it's the screaming eagle. We're talking 5,000 points down, 5,000 points straight back up while no one expected it. What are the strategies you need to get through this environment? That's what we're talking about, that and more. 833-964-PLAN. That's 833-964-PLAN. Go to our website. You know what it is. GetRetiredStayRetired.com. GetRetiredStayRetired.com. That web address says it all. We want to make sure you stay retired. Now, joining me in the studio, David, I think a topic that you thought would resonate well with our audience, because our audience is information junkies. It's people that love learning. What was the topic you keyed up for the A block here?
Silver linings of market volatility. And I think that those that were able to execute quickly were certainly rewarded if they took advantage of some of those opportunities, at least over the last 30 days. As you pointed out, I mean, this is almost a 14% swing in major indices over the last month.
So, David, talk a little bit about what we did to be opportunistic for clients to protect from the downside, what we've done to take advantage of taking some quality stocks to buy those things that have fallen harder, and what should people learn? What are the silver linings of learning that come from the screaming eagle, the pops and the drops of the last 4 weeks?
Yeah, I think there's a few different scenarios that we can run through. First, for those that were aggressive investors, 2025 is all about mean reversion. Things that have done well the last several years have come down to earth, and lots of stocks that were out of favor have come back into favor. And despite some of the recent policy changes and trends, there were actually a handful of stocks that actually had really good performance through April. And those that were paying attention and could create a shopping list were able to sell some of those stocks into market strength to buy some of those beaten down stocks. And if we think about it, a lot of the stocks that have been beaten down the most are a lot of the big tech companies that a lot of people wanted to own, but could never get in because they felt like they were paying a premium. And I think those that could have a systematic process to just take advantage of that worked well. But I think here's the key. All of this transpired very, very quickly. And if you didn't have the opportunity or the process set up ahead of time, you weren't able to execute and kind of take advantage because they were short-lived opportunities. I mean, it's hard to imagine, like you said, that we had this huge pop after the last week.
And that is one of the reasons you need to have a team-based approach to the stewardship of your money. If you work with an advisor that's not a part of a dedicated team who has people like dedicated traders, you can't do that. So, David, how are we set up at VestGen? How is our local office able to function while we have conversations with the clients and families that we serve?
Yeah, I joke with clients all the time. There's a few team members that you don't see very often because they're chained to their desk, but those are the folks that sole responsibility when the market opens till market close, they are at their desks executing on predetermined plans. So, it's not to Exotic, it's good old fashioned whiteboarding of, hey, if these things go on sale, we would really consider buying them. And a lot of times when you write your shopping list down in the whiteboard, not everything goes on sale. But when we do have some opportunities, we want to make sure that while we're deliver pure, tangible financial planning in the conference room, that there's folks behind the scene, dedicated traders that you say that can actually execute at agreed upon prices. So I think that's probably silver lining number one is, as we've just seen, for those that could act quickly, there's a lot of value in the arbitrage between how different stocks have performed.
David, before we do the second, I'm going to talk about that. I was very proud that we were able to sell a communication stock that had rallied in price to buy a semiconductor stock that had fallen deeply in price. I was very happy that we were able to take a consumer staple name that had held up and swap that into a computer software company that had dropped in price significantly. Now, that's just an allocation change of stock to stock, but that's an example of taking advantage of the price arbitrage between different sectors in the market that all traded differently during the risk off to risk on environment of the last month. If you'd love to learn more, you can. 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. Now, David, you mentioned a second silver lining. We're talking about silver linings and lessons learned from the last month of drops followed by pops on Wall Street. What's number two, David, that you think people need to contemplate?
After-tax returns. So I know on several shows you've talked about direct indexing, but one of the benefits of direct indexing is it allows you to stay invested, but take advantage of tax swaps opportunities. So I'd be more than happy to walk through what a tax swap is, but you do a really good job, Craig, of explaining what direct indexing is. So why don't I turn it over to you? You explain that, and then I'll talk about how this could have really helped benefit portfolios in the last 60 days.
Very simple. I think people know that they could buy a mutual fund that tracks the Dow Jones Industrial Average. I think people know that they could buy a mutual fund that tracks the S&P 500. People can buy an ETF or an index fund that tracks the S&P 500. And David, how many stocks are in the S&P 500?
About 500.
About 500. David, would it make sense that if someone owned all 500 stocks in the proper weighting, they would have the same performance of the S&P 500 mutual fund or S&P 500 ETF?
I would agree.
Yes. So what if I challenge the listening audience? What if you own the individual components of the stock index? You'll track the performance of the stock index, but you'll also have an opportunity. The opportunity is when you own the components, you get to sell the losers and book a tax loss. So case in point, someone who is simply replicating or sampling the S&P 500 this month using the philosophy of direct indexing was able to go ahead and stay fully invested, but they were able to book capital losses that they will be able to use to take a deduction on their tax return. And I just tell people that if you own an S&P 500 mutual fund, you own an S&P 500 ETF, there might just be a better way in your taxable accounts to get the upside of the index, but have the ability through volatility each year to get tax deductions for your return. And some of the things you can do with those tax deductions on your return is, one, you can use them to offset your other income. Two, you can use those tax deductions to offset gains on the sale of a piece of real estate, the sale of rental property. Three, you can use those tax losses to offset the sale of a business. Four, if you have losses that exceed your gains, those losses go into a loss piggy bank. And then in a future year, when you have lots of profits, or in a future year, you sell a house, the future year you get liquid on your business, you can unlock that lost piggy bank to negate away your tax picture. That is the concept of direct indexing in taxable accounts. And if you want to learn more, you can. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. David, 60 seconds. Sum up the two silver linings from the drop followed by the pop and lessons learned for investors.
Number one, for those that are prepared and have their shopping list created before the volatility comes, that gives everybody an opportunity to perhaps buy some risk assets at pretty darn good prices. And I think people that had that going into the year were able to execute in April. Number two, for those that are long-term investors that always want to stay invested in the market, isn't it great that you were able to do some tax swaps in the month of April and then benefit from the market's recovery so that we're generating after-tax alpha or after-tax returns? Because you know that there will be some winners this year, and now you've just been able to avoid some of those capital gains taxes moving forward.
So we want to help you get retired and stay retired. This show's all about sincere and actionable ideas. We got to pay a couple bills. That's a nice way of saying run a commercial. In the meantime, you're listening to In the Know with Craig Bolanos and David Bolanos, VestGen Wealth Partners on your favorite station. You know the call sign, AM 560, The Answer.
With Craig Bolanos on AM 560, The Answer, where his goal is to pummel you with financial know-how until you say uncle.
833-964-PLAN, 833-964-PLAN, getretiredstayretired.com. That's getretiredstayretired.com. We were talking about silver linings that create lessons learned from the massive drop followed by the pop that has been defined over the last 4 weeks. And we covered two silver linings in our A block. Well, in B block, we got to talk about number three. And number three is after tax returns matter, not just for equity holders, boy, they matter for bond holders. I think everybody knows by now that after the Rose Garden speech, there were investors that made the bond market get a little crazy. The bond vigilantes came out of hibernation and caused some pain and consternation for bond investors. Well, that is an opportunity, because if you have a AA rated 5% bond maturing in May of 2028, issued from the state of Texas, that bond might have gone down. But you could probably sell that AA rated 5% Texas bond maturing in 2028 and replace it with a AA 5% Tennessee bond that matures in 2028. You're literally taking a security and replacing it with a almost but not quite identical security to stay invested to earn the tax-free interest that you want, but you get to book a capital loss in the transaction. How awesome is that? It's fantastic. Get 5% interest rate, but you get to book a tax deduction along the way. So tax loss harvesting for equities, tax swaps for bonds, it's not a once a year thing. It's an all the time thing, but it takes a team-based approach because you have to have dedicated people to do that craft for you. And that's what we do, and we do it well. If you want to learn more, you can and you should. GetRetiredStayRetired.com. Now, item number 4 on our list has nothing to do with portfolio activity. It has everything to do with the intersection of strategy and taxation. Because what we talk about all the time is you want to future-proof. And one of the biggest considerations for all of us is TIR, which David stands for?
Taxes in retirement.
Taxes in retirement. So one of the things when you have drops that you can do to future-proof yourself from taxes in retirement is what strategy, David?
In-kind Roth conversions. So Roth conversions have been a very popular topic in financial planning the last several years. A lot of folks were racing to try to convert as much of their traditional IRA money into Roth IRAs before taxes go up. And generally speaking, I think that's a good strategy for a lot of folks, depending on what their 1040 looks like. It's not the right strategy for everybody. Oftentimes, it's the right strategy in the right tax year. But for firms that have a little bit of gray hair that are really on top of this, one of the strategies that we use that is really tested in the trenches is, as opposed to just picking a dollar amount for your conversion, I think we need to take it one step farther. How about we convert a particular asset? Most people are guilty of taking the simple path. We want to do a $50,000 conversion. So they sell $50,000 of assets, they transfer that cash to their Roth IRA, and they reinvest. But if we're thinking ahead a little bit and we want to be a little bit more tactical, again, think about all the stocks that have had a tough time this year. There's some great large cap stocks that are down double digits for the year still.
Let's name some names, David. I remember when everyone's favorite darling, the manufacturer of their iPhone, Apple, I remember when it was nothing short of $245 a share. And then I remember Apple going below $200 a share. So, David, if someone wanted to do a Roth conversion in kind using Apple that used to be $245 a share and dropped to below $200 a share, how is that advantageous?
Well, if you're a believer in Apple long term, what you're banking on is you're doing a conversion of that stock at a very low price. And when you transfer it into your Roth, you'll get that rebound all in an account that's tax free. And so, what I think people need to do is, instead of just blindly selling and reinvesting, you go through your portfolio methodically. You can probably cherry pick several investments that maybe have had a tough start to the year. But if you believe in those long term, you're really creating significant alpha, because you will most likely get huge rebounds down the road. And these are long-term strategies. So now is a great time to think about that. But again, how does that get done? It takes time in the conference room to actually figure out how you're going to execute. It's not something that can just be quickly done the last couple of weeks of the year.
So I think you have it there. Silver lining number 3, what we learn, lessons learned from big drops with big pops, is Roth conversions were the thing to do. And during times of volatility, instead of converting cash, cherry pick those assets that have fallen in value, because what falls the hardest in value likely has the most opportunity to pop. That's why in-kind conversions make sense. If you want to learn more, you should. 833-964-PLAN. That's 833-964-PLAN. GetRetiredStayRetired.com. Now, as a public service announcement, we used Apple as our example, but that is not a recommendation to buy or sell Apple. That's just an example of a widely held stock by most people that had fallen precipitously in value during this most recent period of time. Well, that brings us to lesson learned number 5. As if you're just joining us, we're discussing the silver linings learned from these large drops followed by pops is this: you always get a second chance in life. When it comes to investing, that means you always get a second chance to do the right thing. Most people are coming into the weekend that is Mother's Day weekend. Happy Mother's Day to all the moms out there. Most people are coming into the weekend with portfolios at or near break even, aren't they, David?
Yeah, it's hard to imagine with all the changes that have transpired that we could come back so quickly, but we're in striking distance of being basically at par value for the year.
Now, if you have portfolio values that are nowhere near break even, you have a larger problem. You should give us a call. We'll get you on the right track, 833-964-PLAN. But widely speaking, a client who is intentional, measured, properly diversified is roughly back to where they were, plus or minus, in January. So knowing everything that you know now, knowing everything that has unfolded, knowing where we might be headed, how do you want to curate your portfolio for the remaining 7 months of the year? Because you're getting a second chance right now with current prices to do just that. So do you find that you actually have more risk in your portfolio than you recognize? Do you find that you didn't follow our methodology of rotating and owning not just growth stocks, but you don't have enough value? Do you find that you're only owning fixed income that's perpetual, meaning large bond funds, as opposed to funds that have defined maturities? There's a lot of different things you can do, including revisiting geography. I think everyone's getting a lesson in currency right now, David, as they see international markets taking the pole position. That's Europe and Far East over EM. Now, don't get me wrong, listening audience. You know I wave the flag. You know I'm patriotic Craig. You know investing in America through great companies of America is the best way to ensure that you grow your capital over time. But we need to take a look at how currency and trade create arbitrage, which is what David talked about before, in order to get through these times. So I think we've talked a lot about silver linings, David. I like to keep things simple. I've got 5 fingers on my right hand, 5 fingers on my left. We just gave people 5 ideas, but I close again with what we just mentioned. Everybody, you always get a second chance to do the right thing. Ask yourself on this Sunday morning, what do I want my portfolio to look like when I grow up? What do I want my portfolio to look like right now? We're basically back to where we were January 1st. The decisions you make right now are the critical decisions for some people, not just for the next 7 months, but for some people, what might be the next 7 years. And we want to help you. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. 833-964-PLAN. 833-964-PLAN. Well, as I said before, we're going to take a small break. I'm going to grab an unsweetened iced tea, a quick swipe of this bagel, and we've got more sincere and actionable ideas for you and your loved ones when we come back. You're listening to In the Know on AM 560, The Answer.
More In the Know radio? You can't handle More In the Know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
We've said it at least 17 times by now since the start of the year. We came into 2025 with pragmatic optimism. Our investment and implementation theme to support that was diversifying your diversifiers. We may find ourselves in a trading range. That's the 5,100 to 5,750 on the S&P. That being said, if we're in a trading range, you stay there up until we get the following things. 1, we need clarity on trade. I was thrilled with the announcement courtesy of the UK this week. I'm thrilled to know that we're meeting China in Switzerland, but trade is not yet done. Number 2, we need those interest rate cuts. Don't give us 1, don't give us 2, give us at least 3. Third, we must have a renewal of the Tax Cut and Jobs Act. I'd like an expansion, but at least we need a renewal. But if that means year 3 of the pattern is the lowest return year, 23 was great, right, David?
Yeah, 24 was pretty darn good too.
And 25? If it follows the historical pattern, it might be about a search for yield, a search for income. David, how do people secure a search for yield, a search for income, if they don't want to do an annuity? And again, nothing wrong with annuities. I love annuities for income. But David, people hear about annuities all day long. Let's talk about the things they're not hearing about so they can have another voice and consider diversifying their income diversifiers.
This is going to be a topic that I think gets a lot of attention because, to your point, Craig, right? Some people always want to stay fully invested in liquid capital markets because that's how they've become financially successful. They've rode through it. But I think where this conversation comes from is, what if we have a market that's just more moderate? Like you outlined, year three of that bull market, at least since 1950, you can typically count the returns on one hand. So if we don't have a rip-roaring bull market, but we also don't have a bear market, then we're probably trading sideways or range bound. So we might need some income. There's a few places we can look, right? Sometimes not the most appealing investments on the surface, but what's simple and effective is you're actually getting paid on fixed income today. So if I knew I was taking monthly distributions from my portfolio, I would consider having some basic laddering strategy in my portfolio where I could create permanence and definition, and I wasn't concerned about what the Fed does with interest rates. So again, if I'm buying individual bonds, I know when I buy them, my yield to worst, right? What I'm going to get if I hold that bond to maturity. Number two, if people are nervous, they tend to flock towards higher quality, slower growth companies. Clearly that's happened, I think, the first 4 months of the year. And a lot of those companies pay dividends. I would caution people that they probably don't want to find the highest dividend yielders. But if you look for companies that have grown their dividends on a consistent basis, you can build a pretty high quality portfolio that's going to provide you with a long-term inflation hedge. So first is simple, bond ladders, because you can construct your customized yield, customized maturity. Two, dividend growers. And then three, as we talked about the other week, this might be the time to embrace some non-traditional investments. There's a reason that people who are cash flowing from retirement accounts might want to include dividends and interest from things like private credit and private real estate, because you're simply collecting the rent, right? And the way I think about retirement is it's all about what comes in versus what goes out. And if we have things that just pay monthly dividends, and maybe some of that's hard assets, like I said, then if we have a slowing economy, but we have a little bit of inflation, hard assets make sense in this environment. So you don't need to always buy an annuity. At the end of the day, what's the insurance company doing for you anyway? They're hedging their risk by buying bonds. If you want control of your money, you can just buy the darn bonds yourself. And that's what we end up doing for a lot of clients at VestGen.
That is fantastic news. David, so I think really taking control, creating that permanence and definition is a great idea. But for those who want to seek a tax-deferred investment, someone who wants to keep it very simple, what's an alternative that people can use in an annuity form that's simple, basic, and easy that might replace a CD or could replace a money market for cash that wants to be held for 3 to 5 years? And what type of rates could we command on that?
Yeah, I think you're referring to a MYGA, MYGA, multi-year guarantee annuity. And you know what? A lot of people don't talk about those very often. And I think part of the reason is the insurance brokers don't make a tremendous amount of money using those products. So they usually go to things where you're locked in for 10 years with all these bells and whistles, very complicated. But as you alluded to, the allure of a multi-year guarantee annuity today is it's a set interest rate and you get to determine how long that goes. As an example, do I want a 3-year, 5-year, a 7-year? And you just lock in that rate. And your risk is really, are you getting this from a good or poor insurance company? But I mean, 5-year MYGAs are paying a little bit north of 5% today. So as a tool in your retirement tool belt, I certainly think that could play a role if we want something that's just going to have a known outcome. Is it going to get someone wealthy? Probably not. Could it help keep someone wealthy? I think the answer is, yeah, there's a good chance that that could play a role. and it allows you to sleep at night in certain cases. So it's something that should be looked at, maybe as opposed to having to sign these long dated contracts where the crediting methods are very hard to understand.
David, that's a very sincere and actionable idea. So if you're a client, and we talked about silver lining number 5, lessons learned from the big drop and the recent pop. Investments are back to even for the year. Or at least they should be. If you want to take a little Tylenol because you want to sleep a little bit better at night, build out some fixed income, build out some bond ladders. Or if you want to keep it super simple, consider what David just mentioned. If you can lock in 5.2, 5.3% each year for 5 years in a very simple and straightforward multi-year guarantee annuity, maybe you do that. Again, none of these things cure, but all of these things are tools that you can use to build a well-curated, intentional portfolio unique to the parameters, circumstance, and tax profile that you as a family demand, can, and will achieve. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Now, I think what sets VestGen apart, what makes us a little bit different, is so many people talk about comprehensive planning, but that's comprehensive planning. What you really need is multidisciplinary specialists. You need your fiduciary advisor, your registered investment advisor. You need your certified financial planner to do your goals-based and cash flow-based reports. You need your estate attorney. You need a CPA. You need a retiree healthcare expert to navigate the alphabet soup that are Advantage and Medigap plans. You need a continuity of care specialist. That's a long-term care advocate who can create a plan to help you self-insure, partially insure, and you need a wealth advisor who can be forward-facing, acting as your liaison for all of those different professionals for the coordination of care under one roof. That is the VestGen difference. And again, we invite you to learn more. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. You're listening to Craig and David Bolanos in the know. VestGen Wealth Partners, AM 560, The Answer.
Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
David said to me on commercial break, let's make sure we're not generic. Let's be specific. And what are some of the things that we're looking at that can really drive long-term value in a market that's really finding its way? And I've talked about this a couple of weeks ago. I'm going to talk about it again. We believe that there is expected to be a very large and addressable demand for global infrastructure. Some studies predict that there could be $94 trillion of investment needed. That's 94 trillion with a T through 2040. That would amount to north of a $3.7 trillion annual spend. And when we say infrastructure, people oftentimes say, well, what do we mean by infrastructure? Number one, digitalization. Everybody knows that data is the new gold. And data, your data, it's the fastest growing commodity in the world, with internet protocol traffic expected to increase by more than 13% compounded per year. Why is that? Not everybody has the internet. Not everybody has high-speed access. This is a global setting. So what does this mean? There is going to be a race for infrastructure when it comes to data centers. Data centers, data centers, data centers. This administration knows how important data centers are. This administration is committed to keep us in the lead, but to keep us in the lead, we need to continue to grow, build, and innovate. Right now, the U.S. has more data centers than the next 10 countries combined. Right, David?
And what we learned through this last earnings season is every major tech company is still putting money into that, right? Their CapEx numbers, capital expenditures, are very large to make sure they can keep up with the demand. So I think that's the proof that this isn't slowing down, right? This is going to continue to evolve and grow over time.
And we're talking about investing in the thematic of infrastructure. And if you're going to have data centers, those data centers are going to be connected by fiber optic networks. And those data centers are going to be further supported by cellular towers. But what else is infrastructure? It's not just digitalization. Infrastructure is this. It is energy. It is all forms of energy. Think electric, gas, transmission, district heating and cooling, liquefied natural gas terminals, and think of how many countries now outside of America. Because David, I don't know about you, I've never worried about my electricity not being on. I've never worried about the natural gas not flowing. We've got clients all across the country. Some are on propane, some are on heating oil. No one worries about getting a fill. But you go to other places like Europe, energy security is a priority and a must because they used to get it all from Russia, which is a big gas station, and now they worry. So investing in energy, district heating and cooling, electric gas transmission, distribution, liquefied natural gas terminals, I think people need to look at that. All of this screams opportunity. And how do you participate? There's lots of ways to participate, but we believe strongly that if you're building a portfolio of digital infrastructure, industrial infrastructure, energy security, energy transmission, that is a cornerstone of growth going forward based on nothing more than age wave demographics, technology deployment, and bringing the rest of the world up to an ascertainable standard. David, what else should people know about investing through infrastructure?
Well, I'm only laughing, Greg, because when you were saying we don't have the problems here, I did think of a couple of states in particular that might be worried about their power grids not working, but that's a story for after the show. You know, one of the things I think is interesting, and we've had a lot of conversations with clients about, is a lot of folks who started to read up on tariffs and the pros and cons were like, you know, what's the point? And we've heard a lot about trying to gain control of distribution and ports. And it's interesting, right? In March, there were several very large private equity firms that actually started to buy ports in other countries, right? Like near the Panama Canal, right? So I think, you know, you mentioned data and how that's like our number one resource, right? But then controlling distribution too. And these are investments that are actually available to higher net worth investors where you can get access to them. So data centers are one, distribution centers are number two. Everybody that drives down the highway sees all these gigantic buildings. It's all of the packages that are going to be delivered.
Tell me that distribution, what we call industrial warehousing, is a direct play on the incredible amount of e-commerce expansion. Thank you, Shopify. Thank you, Amazon. Thank you, Walmart. And that fulfillment demand for every retailer who wants last mile delivery because they don't stock every color, they don't stock every size, but they commit to get it to you within 2 to 3 days. And how industrial warehousing not only has demand, but has the opportunity for improvement because there's going to be increased profitability due to robotics, powered by not just AI, artificial intelligence, but agentic AI. So yes, I'm excited. Infrastructure plus industrial warehousing. David, keep going. This is great.
Well, I would just say a lot of times we think about it just where we live. So when we drive down the highway, we see it. But most of these investment opportunities are on a global basis. So when you're participating in these investment strategies, it's not just what we've built here, it's what they're going to start building throughout the rest of the world. And to participate in that, even to a very small extent in a portfolio, I just think is a really powerful thing to do if we think, where are we going to be in the next 10 to 15 years? So, you say, Craig, like, this is the year to make sure you diversify your diversifiers as we rewire the global distribution system. I think small pockets of this stuff at the margins really make sense for a lot of investors, not everybody. And it's something that we've been participating in for a while, and I think we'll continue to do so long term. And the other thing I want to add real quick to that is, if you don't have this, or it's never been brought up to you, you don't want to just ask someone to pull it off the shelf for you, right? Because there's a lot of investment opportunities, but if no one's doing the due diligence behind the scenes, I think that's an issue. And in part of having this larger ecosystem that we have within VestGen, there is a documented process and evaluation process to go through everything that's out there to really just curate a very specific opportunity set for the clients that we work with. And I can't, I guess, say enough how important I think that is moving forward in case this becomes a very popular strategy.
So I think if you want to learn more about infrastructure, you want to be a part of that $3.7 trillion annual spend. You don't deny the fact that e-commerce and last mile delivery and concrete bunkers with 80 garage doors, seeing trucks pull in and out, it's an undeniable trend. If you believe and want to participate in that stuff, David said it might be best not to do it through a mutual fund. It might be best to do it through an alternative investment that gives you direct access, that allows you to be a direct owner. And if you want to learn more, you can. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Why do we talk about this stuff? Because the future proofing of someone's retirement is important. And we can't rely on the last 10 years looking like the next 10 years. So this is an execution business, and you have to innovate. And the strategy of implementation with research led by technology is a great spot to be. And I encourage you to experience just that. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. All right, more to come after this break. In the Know, VestGen Wealth Partners, AM 560, The Answer.
Ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Oh my gosh, it's true. The American Eagle was not just one of the greatest wooden roller coasters of all time. The Eagle, the Screaming Eagle, that's what the stock market has been. Massive drops followed by big pops. And that's why we talked about silver linings and lessons learned. That's why we talked specifically about diversifying your diversifiers, the search for income. But David, this is a great time to get retrospect. What do you want to share as we close out today?
Use this market, what just happened last week with the outline of the trade deal, as your opportunity to reassess and be a good student of the game. No one is ever perfect with this stuff. But if we think about some of the risks, right? People are still nervous about inflation. They're nervous about slowing growth. That's stagflation, right? Are we predicting that that's what's going to happen? No. But what I would encourage people to do is go back to the 1970s, take a look at 2000 to 2009, 2010. We call that the lost decade of investing, and revisit strategies that worked well through those trying times, because maybe some of those things should get implemented into your portfolio. Then what I would encourage you to do is to say, hey, look, maybe some of those things are relevant today, but maybe we need something new. And the something new are some of the things that we just talked about, which is, do you think AI is dead? I don't think so. It may have been put on pause temporarily, but information, data, that is going to be the wave of the future. And if you want to invest in non-correlated assets where you get to participate in building out some of that infrastructure, you can do so. You just got to find a firm that has experience doing so. And we're a really great fit for the right families on that stuff. So I think the takeaway is lots of information out there, but take this time right now to step back. And like you said, Craig, if you go back to January 1st, knowing what you know now, how and what kind of modifications would you choose to make?
833-964-PLAN. 833-964-PLAN. GetRetiredStayRetired.com. Go out to that website, GetRetiredStayRetired.com. Download our 2025 tax guide. Download our trade war publication to get some insight into the thought leadership and take advantage of a visit. It's time for a professional reassessment. It's time to make sure you're not going to survive. You deserve to thrive. And VestGen Wealth Partners, we stand ready to help you do just that. Happy Mother's Day, everybody.